Hello and welcome to the final module of the Introduction to Investing Masterclass, Module 7. I'm Kate Wally, a wealth executive here at Goodbody, and in this module I'll be giving you an introduction to sustainable investing and we'll review the most important takeaways of the masterclass. You might have heard a lot about sustainability in the media, but what is sustainable investing, and is it possible to achieve returns on our investments while remaining sustainable? Sustainable investing incorporates ESG factors into investment decisions to better manage risk and generate sustainable long-term returns. It complements traditional analysis and portfolio construction techniques. ESG has become a bit of a buzzword, but what does it stand for? Environmental incorporates climate change, natural resources, pollution, waste, and environmental opportunities. Social relates to human capital, product liability, stakeholder opposition, and social opportunities. And governance refers to corporate governance and corporate behaviour. ESG investing is often used interchangeably with sustainable investing. Sustainability means fulfilling the needs of current generations without compromising the needs of future generations. It aims to ensure a balance between economic growth, environmental care, and social well-being. Now, there is strong recognition that ESG factors are economically important, especially in the long term. ESG engagement is defined as an active dialogue between investors and companies on ESG factors, and it provides investors with the opportunity to discuss ESG risks and opportunities with companies. So how do you become a sustainable investor? You can start by deciding which part of ESG is the most important to you. It might be combating climate change or promoting social equity. If you are only investing in stocks, you can do your research as you would with any stocks and consider the ESG credentials of the companies or the sector you are interested in. All public companies have an ESG score, which provides a measurement of a company's environmental, social, and governance performance. They evaluate things like carbon footprint, energy efficiency, health and safety, business ethics, and risk management. However, it's important to note that currently there is no standardized measurement of ESG ratings, which means that companies might score differently depending on the agency that is rating them. You can also talk to an advisor and look at investing in an ESG portfolio. When considering funds to invest in, you can look at how they are classified under the Sustainable Finance Disclosure Regulation, or SFDR for short. This is an EU regulation introduced to prevent greenwashing and designed to improve transparency in the market for sustainable investment products. Under SFDR, funds are classified in 3 categories. Article 6 covers funds that do not integrate sustainability into their investment process. Sustainability risks and opportunities are not a driving force for investment decision-making for funds in this category. Article 8 applies to financial products promoting environmental or social characteristics. And Article 9 covers financial products which have a sustainable investment as an objective, and an index has been designated as a reference benchmark. Before it all sounds a bit too complex, just remember that if a fund is classified under Article 6, it means the financial product does not integrate any ESG factors or sustainability. Whereas funds classified under Article 8 integrates ESG as standard, and Article 9 focuses on funds targeting specific sustainability themes. Green bonds. Another option is investing what are called green bonds. Green bonds work the same way as normal bonds, but the money raised for them is specifically allocated to projects that positively affect the environment, or they contribute to the fight against climate change. They can be issued by countries, companies, and commercial banks. Green bonds are sometimes referred to as labelled bonds, which collectively describes green, social, or sustainability-linked bonds. What are the risks of green bonds? The risk profile of a green bond is basically the same as a normal bond, which you learnt about way back in Module 2. As you might remember, bond prices are inversely related to interest rates, which means a rise in interest rates will lead to a fall in bond pricing. And the rising and falling of interest rates can be significant over a long period of time. Green projects will typically have a long-term timeline, especially if the project is building some kind of green infrastructure. Thus, the bond issued to finance the project will also have a long-term timeline. In general, green bonds have a longer duration profile than non-green bonds, so investors will have to accept additional duration risk. There are, however, some shorter maturity green bonds available, and as investors move towards sustainable investing, there will be more shorter duration opportunities available in the market. Green bonds have grown hugely in popularity. At the end of 2022, the green bond market surpassed the $2 trillion level, A total of $190 billion of green bonds were issued by governments throughout 2023, including a €10 billion green bond issued by Italy. According to data from Bloomberg, impact bonds totaled $939 billion in 2023, up 3% from 2022. But are investors seeing returns from sustainable investing? According to Morningstar data, results from the full year of 2023 showed that sustainable funds outperformed traditional funds across asset classes. In equities, sustainable funds returned 16.7%, while traditional returned 14.4%, and fixed income sustainable funds beat traditional by 3.6% in returns. The data also shows that while sustainable funds are currently only 7.2% of total assets under management, the market is growing, with inflows in Europe of $146 billion, or 5.8% of prior year-end AUM. The good news is that sustainable investing is here to stay. Investors are adding ESG-focused allocations to their portfolios, thus contributing towards the fight for a better future. If you're interested in ESG investing, contact a financial advisor to get started. I'll be back in part 2 with a roundup of the most important learnings of the masterclass.